So, what happens when the most powerful economic tool on the planet just stops working? Today, we're going to dig into a really fascinating paper that looks at what happens when central banks are totally out of ammo and how their words alone can end up moving entire markets. All right, let's rewind the clock to 2008. The whole global financial system is, well, it's in a complete free fall. And to stop the bleeding, central banks like the US Federal Reserve pull the emergency brake. They start slashing interest rates. They cut, and they cut, and they just keep on cutting until suddenly there's nothing left to cut. And this led to a pretty terrifying question, right? With their main weapon now effectively useless, just sitting there at zero, was the Fed completely out of ammunition? I mean, how on earth could they restart a sinking economy?
What happened next was, well, it was totally unprecedented. For seven long years, the Fed's main policy lever was pinned down at what economists call the zero lower bound. The absolute floor. They just couldn't cut rates any further. This wasn't just a quick dip. It was a whole new economic reality. So, since they couldn't act in the usual way, central banks started to talk a lot. This new tool was called forward guidance. You can think of it like a promise. The central bank started explicitly telling everyone how long they planned to keep interest rates at zero, all in the hopes of shaping how people and businesses planned for the future. Okay, but this new strategy, it created a huge problem, not just for the economy, but for the very economists who are trying to figure it all out. Their most trusted tools were suddenly, well, they were obsolete. See, central banks rely on these incredibly complex models. You could almost think of them like an economic crystal ball. They're called DSGE models. These things are what they use to simulate different policies and try to predict how the economy is going to react. They're absolutely crucial for making smart decisions. But here's the thing. This crystal ball, it had a massive blind spot. It was designed for a world where interest rates move up and down. It had absolutely no way to understand what a 7-year-long stretch of zero interest rates would do, or, for that matter, how powerful this new forward guidance tool really was.
And that is where this research paper comes in. It offers up this brilliant solution to fix the crystal ball. And the key, the big aha moment, was realizing that what people expected to happen was now a hugely important piece of the economic puzzle. So here's the real game changer. The old models, they only looked at the usual stuff: economic output, inflation, the current interest rate. What this paper did, which was so smart, was add a totally new ingredient to the mix. What was the public's expectation for how long this zero-rate policy was going to last? And for the very first time, this upgraded crystal ball could actually listen to and measure what the public believed was coming. It could turn that feeling of confidence or anxiety about the future from just a vague idea into a hard number you could actually plug into the economic forecast. And once this new model started listening, wow, what it heard was pretty amazing. Public belief wasn't some static thing. It was a total roller coaster, reacting in real time to literally every single word coming from the central bank. Just look at this timeline. It tells the whole story. Back in 2009, people pretty much thought this whole zero rate thing would be over in about a year. But then look what happens in August 2011. The Fed starts making these really specific promises tied to dates on a calendar. And bam, expectations just shoot up. They peaked at over 3 years, right before a surprise announcement in 2013. The infamous taper tantrum sent them crashing right back down. And this wasn't just some random coincidence, As the paper points out, the Fed's specific choice of words, their communication strategy, directly caused this massive shift in what people believed. Their words were having a real, powerful, and now measurable effect. So what this all means is that, essentially, the Fed's words had become a brand new policy lever. By promising to keep rates low for longer, they could directly steer how long people believed rates would stay low. And that belief, in turn, could actually help stimulate the economy right here and now. Okay, but this raises a really big question, right? If forward guidance was helping, just how much damage was being done by being stuck at zero in the first place? What was the actual cost to the economy from having this constraint? This is where it gets really interesting. The researchers used their shiny new model to run a powerful what-if scenario. They asked, what would the recovery have looked like if the Fed wasn't stuck at zero? What if they could have actually pushed interest rates into negative territory? And the results? Whoa, they were stark. The simulation showed that without that zero lower bound getting in the way, the recovery would have been much, much faster.
Negative interest rates would have given the economy the boost it needed to get spending, investment, and jobs all moving again, helping us climb out of the hole way sooner. And listen, we are not talking about a small difference here. Being stuck at zero had a massive, tangible cost. And for the very first time, this paper was able to actually put a number, a price tag, on all that damage. Over those 22 quarters of the zero-rate policy, that's more than 5 years, the model calculated a cumulative loss in economic output of, get this, 45.3%. Just, wow. That is a massive blow to the economy, all because of that one single constraint. But if you think that's bad, the loss in investment was even more shocking. A cumulative loss of nearly 98%, 97.9. That's basically all of it. Think about what that means. Fewer new businesses being started, fewer new jobs being created, and a much, much slower climb out of the recession. All because the Fed's #1 tool was locked in a box.
Okay, so let's wrap our heads around this. This research does two incredibly important things. First, it proves that forward guidance, yep, just as central banks' words, is a genuinely powerful tool for making policy. And second, it gives us a new way to actually measure its impact and to figure out the true cost of being trapped at zero. And all of this leaves us with a really critical question for the future. We now have concrete proof that a central bank's communication can profoundly shape the economy. So the next time a major crisis hits, and you know it will, and interest rates fall back to zero, how will they choose to wield that immense power?